Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, March 20th, 2024 edition of Trading Places live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 25, 30 minutes, maybe a little bit longer as we prepare for yet another market open. On the docket today, big Fed meeting coming to a conclusion. We'll hear from Fed Chief Powell at about 2 o'clock this afternoon, 2 o'clock Eastern, and we'll get the latest on their interest rate thoughts. I think it's rather widely expected there will be no change in the Fed funds rate today, or at least few are betting on that. But the wording that the Fed comes up with, I think everyone will be on their edge of their seat waiting for after last week's February core CPI and February core PPI both came in ahead of expectations. So it kind of rekindled some of those inflation fears. We've seen the 10-year Treasury yield rise back up to the 435 level where we had previously been. Excuse me, we did it. We did it rather quickly. I mean, it wasn't that long ago. We were at 404 level, 4.04%. And then we had the big move up to 435. So just these last couple of days, we've seen a little bit of pullback. We do have the 10-year Treasury yield down a little bit this morning. We'll talk about that in just a second. But what's the Fed going to say today? I think that's really what everyone cares about. They've kind of gone back and forth on what they're going to do down the road. They talked about a couple of months ago, they stepped up the number of rate decreases from 2 to 3. That got the market really excited. And then the next month they came out and said, well, you might be expecting it too soon, that it's going to be later in the year. And so now I think a lot of folks are nervous. Are they going to maybe give one of those rate cuts back? Are they going to go back from 3 to 2? Or are they going to delay it even further because of these couple of inflation reports that came in a little hotter than expected? Or are they going to stick to their, well, this was maybe a little bit of a glitch. We still see, progress being made. We're not ready to cut yet, but we do see that still in the forecast. We're still expecting 3 rate cuts. I mean, which way is Powell going to go? And your guess is as good as mine. I mean, I've seen, in my opinion anyway, I've seen him waffle back and forth, kind of giving the stock market what it wants to hear and then taking it right back away. So listen in at 2 o'clock and watch to see what the market does after this meeting, whether any big breakdowns, whether the market interprets it as, being more bullish, maybe more dovish in the bond market, which in turn could send us to new highs. We're going to take a look at the numbers here in just a second, but I can tell you that the S&P 500 yesterday, after being weak in the morning, rallied back and set a new all-time closing high yesterday at 5178, which was just 3 points above the previous all-time high close, which was 5175. So that's the backdrop for what could be a pretty volatile day, especially after 2 o'clock this afternoon. Leading up to that, who knows? I mean, yesterday morning we had a market selling off a little bit in the morning, and then we had this steady buying that just took place all day long, or it seemed like it was all day long, until maybe the last hour or two where we saw a little bit of a pullback, especially more in the small cap area. But overall, I would say it was very, very solid action in the market. It seemed like there were a lot of buyers still anticipating maybe another breakout after we get past the Fed. Because certainly, when you look at the Fed, the stock market doesn't like uncertainty. That from years and years of watching the market, anytime there's uncertainty surrounding something big, and interest rates are big. I mean, there's no sugarcoating this. What happens with interest rates and what happens with earnings, that's what drives the stock market. Those two factors. I mean, you might throw some other things in there. If you want to throw politics in there, whatever, short term, blah, blah, blah. But for me, it's all about earnings and interest rates. And if the Fed signals that rate cuts are going to be delayed, or maybe even says, we don't know, how many cuts we're going to have, Anything like that that makes the market more nervous and uncertain likely leads to selling, and rightfully so. Anytime rates remain higher, then your valuations are not going to be as strong. And when rates come down, if everything else is equal, when rates come down, valuation should go up. Anyway, that's where we stand heading into this Wednesday morning. Let's take a look at what happened yesterday. Get this party started. The Dow Jones Industrial Average finished up 0.8%, 320 points yesterday. As a big move on the Dow. S&P 500, despite the earlier weakness, still finished up more than 0.5%, gaining 29 points and closing at a new all-time high at 5178 and change. The NASDAQ 100 also moved into positive territory, gaining 0.25% at 47, rising 47 points. And the mid caps jumping 0.75% to or rising 21, almost 22 points and getting back to 29.39. We were up testing that 3,000 level earlier in March, and with the strong finish yesterday, I wouldn't be surprised to see the mid caps make another run at that 3,000 level. Small caps gaining 0.4%, with the IWM jumping about 85 cents. After going back down just below the 200 level, we came rallying back, finished above 202. It was a nice middle of the day rally. Like I said, a little bit of weakness into the close, but overall, pretty strong day across the board. Transports maybe had the most bullish signal of all, because at that 15.5 level or 15.4, which is where we've seen some recent support, I thought maybe we're heading down to 15.2, but we had a reversing candle print yesterday, and I'll show you that in just a couple minutes. But a beautiful, I looked at it earlier. It's pretty close. I don't know if it's bullish engulfing or if it's piercing. Piercing just means that the rally finishes back in the upper half of the prior day's candle body, whereas bullish engulfing completely engulfs it. So bullish engulfing, in my view, is a little bit more bullish than a piercing candle, but they're both considered reversing candles. We'll look at that in just a minute. But transports finished up 122 points. That was almost 0.8%. Really strong finish after it looked like maybe we were breaking down. I always like to see that, those kick saves and those big reversing candles. Energy, utilities, discretionary, kind of a weird combination there. We got a neutral sector, defensive sector, and an aggressive sector leading the action. Energy gaining more than 1%, actually 1.14%, continues to just move on a roll to the upside. Short term, I think it's fine to trade energy. Intermediate, longer term, I think we've got to continue to watch the dollar, because these types of rallies, especially on a relative basis to the S&P 500, do not tend to last very long for both energy and materials. That's been the history during the secular bull market. So I think you can ride those. Just make sure you keep raising your stops, because when those stocks turn or when those groups turn, you want to be out of them, at least based on the history over the last 11 years. Utilities rising almost 0.9%, still remaining pretty strong here during the month of March. Back up close to $64. I think they're still, well, depending on what comes up this afternoon with the Fed, if the Fed's more hawkish or talks just a little bit more hawkishly about when these rate hikes are going to start, or whether or not they're going to be, the number of rate cuts are going to be cut from maybe 3 this year back to 2, I don't know. But if they start talking hawkishly, I think you're going to see utilities possibly that there's a problem with utilities, number one, in that, well, it's not a problem. It's kind of a mixed picture, if you will, because if the Fed talks hawkishly, you've got probably money rotating more toward defensive areas, which utilities are part of. So that's beneficial to utilities. But if the 10-year Treasury yield rises as a result of the Fed, then income investors who are in utilities may want to flee utilities for treasuries. So utilities are probably, I think their upside's probably capped unless we have a tremendous sell-off with rates not breaking out. Then I think you would see utilities heavily bought. I'm probably going to exit. I've been holding utilities for a little bit. I mean, I'm up a little bit, not much. I'll probably be exiting. I'll be making a decision before the Fed meeting. I'll probably get out. don't know. I may hold it just as a hedge, but we'll see. Anyway, I think utilities, well, I know utilities historically have been a very, very good sector during the month of March. And of course, we still have another 11 days before we leave the month of March. So can't blame anyone who wants to continue to hedge with utilities. But utilities had a nice day yesterday, rising about 0.9%. Discretionary bouncing off the 50-day moving average, still keeping this uptrend in play. We've seen a little bit of strength coming back into stock like Tesla, which has helped. Amazon's been strong. But as you'll see in just 1 second, there are other areas within the home construct or within the discretionary area, including home construction, that have been very strong, and that's helping to lift the group as a whole. Oil equipment and services from an industry group perspective, leading yesterday, continuing this push to the upside, and that in turn has been helping the energy group. Apparel retail, which had taken a little bit of time off these last 2 or 3 weeks, pulling back. Nice day yesterday, gaining more than 2%. Beautiful uptrend. Many of the retailers, even though we had a weaker than expected retail report last week, many of the retailers have held up extremely well and still look good as we go into the latter part of March and toward April earnings. Of course, many of the retailers won't report until May. But right now, this group still looks pretty healthy to me. And then here's your home construction group. Many of the home builders or other areas tied to home building, home improvements, and so forth. Many of these stocks performing pretty well. And yesterday, and look at what we've done in the month of March. If you go back, well, I'm going to show you the 10-year Treasury yield in just a minute. But despite rates going up, you would think that would, the 10-year Treasury yield going up 30 basis points from 404 to about 434, 435. You would think that that would be putting some kind of a lid on these home construction stocks. And maybe to an extent, maybe there is a lid, but you're certainly not seeing a big sell-off in this group, which tells me that the stock market still putting money in this group suggests that there's probably not going to be a lot more movement to the upside in the 10-year Treasury yield. That's one of the signals that I look for as I kind of watch this group, because if we believe that rates are going to go higher, this is one group that would directly be hit by higher rates. So far, not really seeing it there. So if that's a clue, maybe it's a clue that the market is anticipating that once the Fed's done today, we're going to see rates decline again. Moving on. Okay, 10-year Treasury yield. Here we go. Let's get a quick update. Just make sure where we are. 428.5. We're down a little bit more than 1 basis point. Remember, we were just at 435 2 days ago, back on Monday. So I don't know if this is the calm before the storm when we get that announcement at 2 o'clock, but I would be watching this. I think the 10-year Treasury yield, I've said if there's one catalyst that could take the stock market down, it would be a breakout in the 10-year Treasury yield. Even if it's only a short-term breakout and a short-term move to the downside, higher interest rates could be that one factor out there that might actually get the market to sell off a little bit rather than this sideways consolidation that we've seen. Like I said, S&P just broke to a new all-time closing high. Doesn't sound like a whole lot of selling is taking place to me. But if we get a breakout above 435, maybe some of that will change. It'll help in some areas. I think the high, moving up in rates could lead to some more rotation into value-oriented areas. We'll see. But watch 435. That's going to be big this afternoon. S&P 500. So here's the S&P 500 with another solid hollow candlestick. And again, breaking out to another all-time high. I say this no matter how many short-term warning signs I see, and there's still some out there, not a lot, but there's some. Secular bull market many times just puts its head down and just keeps on plugging to the upside. And that's the risk of betting against a secular bull market. So many reasons why we could have gone down. I mean, historically, March isn't a great month. The presidential election cycle tells us be careful in March. The negative divergence on the daily chart, pretty clear here on the S&P 500. Even yesterday, we break to a new high. The PPO is much lower than it's been. I mean, there are lots of reasons out there why the market should be maybe taking a break. We've seen rotation, but it's not. And there is nothing more significant than price action. And that is what a lot of bears don't get, and even a lot of bulls don't get. I think I see so many technical analysts, many that I respect, that keep talking about under the surface issues in the market and why this market is likely to go down from here. I, I've expressed cautiousness, but I would not bet against a secular bull market. In other words, for me, it's about maybe hedging like I have with utilities, or maybe having a little bit extra cash in play to buy in case we do go down. I did that last week. I've already started buying some of my stuff back because the market just doesn't want to give up here. Call it what you want, but resiliency is one of the keys of a secular bull market. Rotation is also a big key. And we're seeing a lot of both. And I personally, I find it to be very bullish. Again, if we pull back, I think it'll be very shallow. 100 points on the S&P would be nice. 200, I think, would probably be about max. That would be 4% from here. That's about all I'm seeing based on all of my signals. I think by the time we get into the next earnings season, as we start to roll into April, my expectation is that we're going to start to anticipate another solid earnings season. NASDAQ 100, this one has pulled back a little bit more. We're not closing at all-time highs like we are on the S&P 500. That's where some of that rotation comes in. But I also wouldn't say this is an unhealthy chart. We're not seeing a breakdown. We're seeing a little bit of weakness in some key areas like technology, semiconductors. Pull up the semiconductors. I don't know if you've been watching. If you've been watching NVIDIA, you're thinking, well, it's not really pulling back. Look at the semiconductors. We were at 16.6, 16.7. We went back under 15,000. We've pulled back 10% in semiconductors as a whole. So yeah, if you're looking at NVIDIA, you're like, well, we really haven't seen a whole lot of selling, which I would agree with. But the group as a whole has pulled back quite a bit and created a lot of opportunities, especially in some of those smaller ones. Let me show you one that I've been talking about. I think I mentioned this one on the weekend, the first weekend market recap that we did on Sunday. This was one that I looked at this gap support right here, top of gap support. Look at what we did intraday yesterday. Took that out, big volume, and look what happened. Massive rally back off of it. So if you bought at gap support right here, would have been a little testy during the day, intraday, but look where we closed. Big reversal. And when I break this one down, look at the big morning selling. What do I always talk about? Manipulation. Gap downs and morning selling. And then what? Late morning and afternoon buying. So in my opinion, this was nothing more than market maker manipulation. The gap down triggered the selling. The selling escalated. And then market makers were there just basically saying, come on down. Let me start buying. And that's what they did all day long. Bought and bought and bought. Rest of the day, we finished right back up near where we opened. All these folks in the morning panicked, got stopped out. And then by the end of the day, everything was fine. Listen, this kind of action is not easy if you're holding a stock or if you're buying into it and you see it keep going down. It's very, very emotional because you're watching money, just fly out the window, literally in minutes. But this is how market makers accumulate shares because they know they've been doing this for a long time. They know once panic button gets hit, they can get a lot of shares. They can get filled. Look at all these shares coming in, 100,000, 150,000 every 10 minutes. This is a small cap company. 150,000 shares is kind of a big deal over every 10 minutes. And you can see the beginning was 400,000 the first 10 minutes as things were collapsing. But you look again, go back to the daily chart. It's a little different picture. Had the big gap up. Look at the volume here on the gap up and move higher. 12 million. Here, yeah, we saw volume pick up. We only had 3 million shares. And look at the big move there. You know what this means. Look at the AD line. Because even though we were down, we came back up, closed near the high. And volume's the multiplier. So you got an increasing volume day and you close near the high, that makes the AD line soar. So this is a stock I like. Semiconductors, like I said, maybe NVIDIA hasn't pulled back, but this one was over $34 and went down to 24 in 2.5 weeks. Way the market works. I mean, this is how market makers buy for their institutional clients and how you and I get sheared in the process. So you got to learn it. You got to know, you got to almost expect it sometimes. You got to hold your nose and buy some of these strong stocks when they're down in the morning, because a lot of times they do exactly what this one did, came roaring right back. IWM, a little bit weaker yesterday, considering the open down below the 200 mark. It got down as low as 199.66. But once again, big recovery. I was talking about the trend line and the channel. I think it was on yesterday's show, or I have so many different things that I talk about, so many different platforms. I'm not sure half the time. Let's see if I can get this. I'm not sure half the time where or when I've said something. But basically, this is what I've been watching. I mean, that right there is almost an absolute perfect parallel channel, where you've got highs going up at the same rate as you've got lows. And so we turned right off of that. So any kind of a pullback, like this morning, I know the IWM, actually, I didn't give you futures, but let's see, we got about 9 minutes to go. Dow futures are down about 0.1%. Spider futures almost flat, down 0.03%. QQQ was up earlier. That's still up about 0.2%, which is about 87 cents on the QQQ. IWM was down this morning. It remains down. It's down about 0.25%. So it's down 52 cents to 201.58. But what I would expect to see, and of course, we got the Fed meeting at 2 o'clock, so we'll see what happens there. What I would expect to see is a test of this trend line, maybe even an intraday break. But then with a rally, you can see we've had intraday breaks before. What I try to do is connect candle bodies as best I can. So literally the open yesterday was almost right on this channel line, and we saw the recovery. What happens today with the Fed? I mean, if we get a good report or at least a good reaction to the announcement after 2 o'clock, and the IWM can get back up through that 20-day moving average, which is where it's failed for 3 days now. Actually, 4 days. We closed below it last Friday, or actually last Thursday. And then Monday, or then Friday, Monday, and Tuesday, you can see trying to get back through and unable, but holding this key support. So I see the short-term issue with the IWM right now from the channel line, maybe intraday down to the 50-day, which is at 198.76, about $1 lower than where we were yesterday. That's the downside. Upside, we're looking almost just a little bit above where we are right now. Looking at 202.73 at the 20-day. Yesterday's high was 202.75. So failing there and coming back down into the close. Which one of these two levels gives away first? That's going to be, I think, pretty important in the short term for small caps. Transports. Let me show you this chart. It does look like a bullish engulfing, but let's take a look at a 3-month chart, see if we can get a little bit. Nope, it's piercing. We did not quite close above the prior day's candle body, which is what I like to see, completely engulfing it. And off of a downtrend, though, this is still a pretty bullish candle. So I would expect transports to rally today off of this candle. Doesn't mean they'll be up at the open, but I suspect before we move lower than yesterday's low, I would expect that we're going to move higher than yesterday's high. And that's what you're really looking for with reversing candles. They're short-term in nature. Now, if they happen to appear at a key support level, which I think this one did at about 15.4, that's where the last two sell-offs have ended, 15.4. We got a reversal right at that level. And you can see the last time we reversed here, we went up quite a bit. Here, we rallied for 2 more days afterwards, went sideways, then back down again. Now we've got another reversing candle. I would expect, again, at least maybe a day or two of movement to the upside. But if the overall market starts to move, that could print the bottom for transports. We'll see. All right, earnings beats. If you want to find my home, go over to earningsbeats.com. That's where we are. You can sign up for a 30-day free trial, no cost trial. Check out everything we offer. That requires credit card. If you scroll down, you will find a free newsletter. This does not require credit card. So if you just want to learn more about us, follow our charts of the day. Maybe you're trying to hone some technical analysis skills, or maybe learning more about how to assess the health of the market, whether or not we're going to go higher or lower. All those things I talk about in the EB Digest. Name and email address, all it takes. Hit that subscribe button. We'd love to have you. And then, of course, later this morning, in about 35 minutes, we'll have our Wednesday live trading room. Every Wednesday, 10 a.m. Eastern. So it'll be during the trading day. Today, one of the first things I'm going to do is I'm going to be looking for reversing stocks. Stocks have been going down for at least 5 days. We have a scan at Earnings Beats that we use, that we publish on our site for our members to use. And I'm going to start with it today to try to find stocks that are beginning to reverse off of recent downtrends. Could be stocks like ACMR that I pointed out. These stocks that have been moving lower, we might see a number of these smaller semiconductors come up on a scan like this, because many of those stocks, as the semiconductor index has been going down, many of them have been pulling back steadily. We may see some of those, especially with the NASDAQ up today. At least looking at the futures, looks like we're going to open up a little bit on the QQQ. That could trigger a lot of stocks making highs today after trending lower for like the last 5 days. And we'll see if we can uncover some reversing stocks. And so in that scenario, what we've really done is we've been patient. We've been disciplined. We've allowed these stocks to pull back. And then you try to get in cheaper just as they're starting to make that turn back to the upside. That's the idea. But anyway, all of that's going to be at 10 o'clock this morning. If you want to join, you can join with a 30-day free trial. So hit that green button, join us, join our service. No payment for at least 30 days. And that means you'll get the next 5 live trading rooms, because it's every Wednesday. You'll get 5 of them during your trial period. I think you'll see the power behind what we do at Earnings Beats. All right. One other announcement. We've made this announcement to our members. I want to begin to announce it to the public. In April, we're going to do what we're calling our Education 4-pack. Every Monday in April, the 1st, the 8th, the 15th, and the 22nd. Okay, not the 29th. So not every Monday, but the first 4 Mondays in April. 1st, 8th, 15th, 22nd, we're going to have a technical analysis topic of some kind. I can tell you the first one on April 1st is going to be on candlesticks. So if you're not familiar with candlesticks, I can tell you, I don't look at charts. I mean, I couldn't trade without candlesticks. I don't know how anybody trades without candlesticks. I think they give us a visual of what's going on in the market. It helps me anticipate action. Just like I was talking about with transports, that reversing candle makes me think the next couple of days are going to be strong in transports. So if I find a transportation stock that I like, it's going to give me more confidence to trade it. So you've got to know these candlesticks, but not just on, big areas like transports, but on individual stocks. So Google, this was our chart of the day today that we sent out, part of our free Earnings Beats Digest. Here you can see yesterday we had a shooting star on Google. That's where you get a gap up, morning strength, and then afternoon weakness. It's like an upside down hammer. So if you think about prices on stocks going down, if you're familiar with a hammer, it means we were just absolutely kind of like panicking, selling off big during the day. And then we come rallying back, and almost like I showed you on that ACMR chart, where we finish back up near the high or at the high. And so the open and the close are near the top part of the trading range for the day. And you have this long, what's called a tail to the downside, which reflects all that intraday selling. So when you see a hammer in your mind, without even looking at anything else, I'm just thinking big move down, big move back up. Somebody was buying in the afternoon after a lot of selling was taking place in the morning. And so this is after an uptrend. A shooting star is a reversing candle off of an uptrend. And by the way, off of this nice rally, what I'm looking for and seeing is a continuation pattern. Left shoulder, neckline, head, lower low. We come back up. We don't stop at where we broke down. Normally, that area right there would prevent or would produce some resistance. We went right through it. That's what would happen during a downtrend. Instead, it's starting to look more and more like a continuation pattern, a bullish continuation pattern that will eventually lead to higher prices on Google. So what I expect after this false breakout, I think what we now have is a neckline. We've established the right side of the neckline. We had a reversal right at the neckline. And I would expect short-term weakness. Well, we already saw one day. Market rallied yesterday. Google was down 65 cents. Now, is it going to continue to go lower? I don't know. Like I said, these candles are technically only good for a day. Most of these reversing candles, if it suggests that we're going to go lower and we go lower one day, I don't care if this goes to up $15 today. I would say the candle worked because we saw selling the next day. That's what I would expect. After that, I don't know. Now, because we're in what I think could be a continuation pattern, an inverse head and shoulder following an uptrend, I think we could see weakness down to about 140 to print a right shoulder. We have a higher intraday right side of the neckline, and I wouldn't be surprised to see a higher right shoulder than the left shoulder. I think going down to these moving averages somewhere in here, filling this gap, could print that right shoulder. And at that point, I would be really bullish on Google short term. If that pattern develops and you see Google back down around 140, probably a pretty good chance I'm going to be in it. And that's where I would look for that reversal. CMG, it's a little after 9:30, so I'll get to the market here in just 1 second. CMG, big news, though, after the bell yesterday. I don't know that I've ever seen this, that I can remember anyway. They announced a 50-for-1 stock split. I didn't say 15. Wasn't 5 without the zeros. 50-for-1. That's kind of crazy. That's going to take the stock at the open to $56. Where we are, look at what the response was in the market. Now, when you have a split, nothing has really changed. What this is going to do, though, is it's going to open it up and make it more affordable for a lot more folks to buy. Right now, $2,900. A lot of people invested in the market don't have $2,900. So unless you're investing somewhere that'll offer you partial shares, you can't buy CMG currently. I mean, there are a lot of folks that can't buy it. When you split 50-for-1, all of a sudden we're going to be back down below $60 a share. So now to buy a share going forward, it's only going to, one share is only going to cost you $60. A lot of folks can buy Chipotle at $60. They can't do it at $2,900. So anyway, that's why we're getting a nice reaction. Chipotle is one of our portfolio stocks. It's been a leader. I mean, you can see the chart. Anytime you own a stock like this in a portfolio or own it in your own portfolio, it's going to make a difference. Chipotle has been a difference maker for us. SMCI, this is another one I've been talking about. I mean, they came out with their secondary offering yesterday. As a percentage of their overall outstanding shares, I didn't think it was that big of a deal. Anytime you get a small company that makes a big move to the upside, if they would benefit from some additional cash, many times you're going to see a secondary offering so that they can raise cash at higher prices. And that lowers the number of shares they have to give away to get the money they want. If they had done this secondary offering at $350 instead of $1,000 or $900, then you would have to have given away 3 times as many shares to get the same amount of capital. So when you get these small caps moving to the upside, this happens so often, and that is the one maybe unwritten risk many people don't think about when they're buying small cap stocks. But if they're breaking out and moving higher, many of them well, maybe I shouldn't say many of them, but I've seen over the years many small cap stocks use the strength to come out with a secondary offering. Strike while the iron's hot. Anyway, this one's going down. Personally, I actually started accumulating SMCI yesterday. And if it goes down further, I'll probably buy it all the way down to about 700. So let's get an update, see where we are. Yeah, we're down a little bit today, down 18 bucks. But I believe, and it's just my personal opinion, that as strong as SMCI was with their earnings report last quarter, and with all the craze around the AI, that whole theme right now, I think as we start moving toward earnings, I would not be surprised to see SMCI take another big move to the upside. I think NVIDIA will do the same thing, although NVIDIA doesn't report early. It doesn't report in April. It's probably going to be in June. But anyway, I think these AI stocks could make another big push heading into earnings season. So I'm just sitting back waiting. I'm actually hoping that SMCI keeps taking a hit. I would love it to come back down near this 50-day moving average. Anyway, that's about it. Let's go ahead and take a look at what's going on in the market. Remember, Fed meets today, 2 o'clock's the announcement. Currently, we've got the Dow down, 0.15%, S&P 500. S&P 500 down almost 0.1%. NASDAQ barely up. Small caps down 0.25%. Mid caps down less than 0.1%. VIX up almost 2%, back up over 14. We'll see what happens with the Fed later today. I wish I could tell you what the Fed's going to do, and I wish I could tell you what the market was, how it's going to react. All I can tell you is that historically, it can be fireworks. And usually the first move after 2 o'clock is not the ultimate move. A lot of times get a big move in the announcement, then we come flying back, and then afterwards there's a conference call and Powell may say something, market back up again, back down. I like to see not only how we finish today, but maybe how the market trades the next couple of days to start to get a better feel for what is really transpiring. Also, after these announcements, a lot of times what I'll do is I'll look at like the sector and industry group analysis, and I'll take a picture of it before the announcement, and I'll take a picture of it at the close, and then I'll also take a picture a couple days later just to see where that strength, where the rotation is based on what the Fed said. In other words, what's Wall Street doing with their money? I don't care what they're saying on CNBC. Forget about that. What are they doing with their money? Where's the money going? Where's it rotating? What do they believe based on what they're buying? That's how you determine where the market's going, not by listening to CNBC. Anyway, have a great day, everybody. Happy trading.